Hi, in this video we are going to see how Binance Futures works. As you're watching this, I assume you have a Binance account already. So all you need is just to go to Futures on top menu, then on the next page click on Open Account. That's it, now you have a Futures account alongside your main Binance account. How to transfer funds to a Future account. Once you open Futures account, if you go to Futures page, you would see a trading page like this. On bottom right box, you can see a transfer button. Click on that and you can easily transfer Tether from your main account to your Futures account. The benefits of trading futures vs spot. In order to make this video as practical as possible, let's say here the commodity or currency is Bitcoin and market is based on Tether instead of US dollar. First, we have to understand differences between spot, futures, and perpetual contracts. In spot trading, it is very simple. You buy or sell Bitcoin by three different types. Let's say price of Bitcoin is $8,500 and you are a buyer, but you think it is a bit too high. You can use limit order and place your order on $8,480. Until the price of Bitcoin falls into your price, your order will be active on buy charts. Now, what if you are in a hurry? You can execute orders of traders who have placed their limit orders on sell chart. This is called market order, and you would be asked to just put the quantity of Bitcoin you want to buy, and the exchange will buy that amount of Bitcoin immediately on the best price available. Next, we have futures. In futures, there are some facts. 1. You don't trade Bitcoin, but rather contracts that represent Bitcoin. 2. Each contract represents one amount of Bitcoin. 3. Each futures period, most likely between 2 or 3 months window, has a closing date, when all contracts will be expired or exercised. 4. Like regular trading, there are two sides, buyers and sellers. Buyers are traders who believe the price of Bitcoin will be higher than it is right now. We call them longs. And sellers are traders who believe the price of Bitcoin at the end of this period will be lower than it is right now. We call them shorts. Now, this was a traditional futures. But what is perpetual contracts on Binance Futures? Here are some major differences. 1. You don't need to be worried about closing date, because there is none. 2. You open your positions, long or short, and close it whenever you want, even seconds after. You can open multiple positions as much as you want. Because this video is about Binance Futures, I will explain just perpetual contracts on the following example. Then we can learn about different types of orders on Binance Futures. Let's say John is bullish on Bitcoin. The price of Bitcoin is $8,000. He has $2,000 in Tether transferred to his futures account. Because he's bullish, he thinks price will go up. So that makes him a buyer and he should open a long position. He uses market order and immediately opens his long position. 2 hours later, price of Bitcoin is up to $8,200. He has two options, either continue his position or close it. So, what is the difference? This is where leverage comes into play. Leverage is a number like 5x, 10x, 20x, and it multiplies everything. Your position, your profit, and your loss. In Binance Futures, the leverage is 20x if the value of your exposure position is less than $500,000. Don't worry, I explained it through my bullish friend John. We know John has $2,000. The thing is, he's very bullish on Bitcoin and he wants to put more money, but he doesn't have like $40,000. In Binance Futures, the default leverage is 20x. So when he opens a long position with all his money, it will be multiplied by 20. That means he will open a position worth of $40,000 or 5 contracts of Bitcoin. Now 2 hours later, the price is $8,200. Because he has 5 contracts, his profit would be $1,000 with just 2.5% change in Bitcoin price. Before John closes his position, that $1,000 profit is unrealized P&L. Until you close your position, your profit or loss would be unrealized P&L. And when you close your position, after deducting fees, it becomes realized P&L. Now, this seems very exciting, and you may think there must be a catch, and you are right. In the following example, we have Jane. Jane is extremely bearish on Bitcoin, and she also has $2,000 in her futures account. She opens a short position when Bitcoin is $8,000. 1 hour later, Bitcoin reaches $8,100. Her exposure, like John, is 5 contracts. That means her unrealized P&L is minus $500 for now. Both John and Jane have invested $2,000 in their contracts. In futures, they call this initial margin. The money you have opened your position would be acting as a collateral. Initial margin is 5% of your exposure position, or in other words, your position would be 20 times bigger than your initial margin when the leverage is 20x. Then we have the most important variable in perpetual futures, maintenance margin. In Binance Futures, maintenance margin is half of the initial margin. Let's back to Jane. When price of Bitcoin reached $8,100, she lost $500. But what happens if the price goes up to $8,200? Her unrealized P&L would be minus $1,000. That means she already lost half of her money she used as collateral, or what we call half of her initial margin. Now she reached to maintenance margin. 3 scenarios could happen here. Exchange calls Jane to increase her collateral simply by adding Tether to her futures account. This called margin call. Jane closes her position and would end up having $1,000 remaining in her account. Jane fails to exercise those 2 options and she would lose all of her money by automatic liquidation. Liquidation price would be calculated based on your collateral and amount of tether you have in your futures account. But always be aware, in a 20x leverage position, if you use all of your money as collateral, 2.5% change in price in opposite direction would put you into maintenance margin, and after that you may be liquidated. At the end, I want to show you different types of orders in Binance Futures. Limit order, that itself has 3 new features named time in force. GTC, good till cancelled. The order will be active until the order fills or is cancelled. IOC, immediate or cancel. The order will execute all or partially immediately and cancel any unfilled position of the order. FOK, fill or kill. The order must be filled immediately in its entirety or will be cancelled. Market order is like a regular market order that we already discussed in this video. A stop limit is designed to prevent liquidation or huge losses. For example, Jane can limit her loss by setting price on 8,020 on stop price and 8,025 on price bar. This way, if price reaches to 8,020, a limit order will be placed automatically on 8,025 price and will be filled on best possible price. Never put the price very close to the stop price. Otherwise, your order may not be filled at all during a sudden rise or fall in price. And the last one is called take profit. Jane thinks she is willing to close her position if price goes down to $7,900. She can use take profit order and send trigger price on $7,900. But isn't this like a limit order? Yes. But if Jane uses a limit order, she can't use a stop limit order. That means she only bets on taking profits, and she would be vulnerable to a price surge. But she can use take profit order and stop limit order simultaneously to manage her risk. At the end, if you are new on futures markets, please put a good amount of time and energy into learning it in order to avoid any miscalculation. I hope this video was helpful and thank you for watching.